Okay, the last time, what we are doing in this chapter, we're gonna, what's the title of this chapter? Stock valuation, right? So we're gonna estimate, we're gonna predict, we're gonna calculate the stock price. And we talked about three different models for stock valuation, right? But in this chapter, we spend most of the time on dividend discount model. We use dividend. And chapter 10, we're going to use free cash flow. So you need to be familiar with both. And we're going to talk about actually another model at the end of this chapter, but that's not a big issue. And remember, what's the concept of valuation? The valuation in finance actually follows economic value. The valuation concept in economics. And economic value tells us what? The value, when you estimate value, calculate value, you look at the ability to generate future cash flows, right? So simply speaking, present value of all the future cash flows. Yeah, that's the today's value. Right? But think about the yes, we're going to use actually dividends, right? Paid to stockholders. We need to remember the definition of corporation. As we said, so many different definitions or characteristics of corporation. But one important characteristic is what? Perpetual life. It exists forever. Corporation exists forever. But when economists develop model, always start from the simplest case, which is what? One period model, 1 year model. And then expand to 2 year model, and then multiple years, and then generalize. Or we're going to come up with a generalized model, right? So step by step. But first, one period model, as we said before, what's the value today? The concept is present value of all the future cash flows you expect to receive. All the future cash flow you expect to receive in this model is only these two, right? Dividends and the stock price after 1 year. So what's the value of stock today? Present value, present value of future cash flows. That's it, right? That's what we talked about. Present value of the future cash flows. And we expect to receive this cash flow within next year, at the end of the next year. Or within the year, or at the end of the next year. Or we just need to discount 1 year, right? 1 year. So that's the stock value today with one period model. So now we're going to expand to 2 period model. Like this, 2 period. So during the second year, the cash flows we expect to receive is what? T2. T sub 2, right? T2. Yeah. During the second year or at the end of the second year, it doesn't matter. Then we expect to sell. What about the price at the end of the year? What's the stock price at the end of the year? We don't know in general, but what we know all about is what? This stock price at the end of the first year is what? Present value of the cash flow the next year, right? Future value. So cash flow you expect to receive during the second year or within the second year. So that's what I write there. What is stock price after 1 year, which is this piece of one? We don't know specific amount, but all we know is what? Present value of the future cash flows. The present value of dividend, one dividend, right? This of 2, expected during year 2. So this is actually this of 2, actually, right? And then plus the price at the end of the second year, right? At the end of second year. So let's write down first. Piece of 1, not piece of 0, right? So piece of 1 at the end of the year. What's the stock price? D2 plus P2 over 1 plus R square. Yes. Oh, is R square? No, 1. Yes. 1. Don't make mistake. Yes. Yeah, because we're going to calculate price at this time, right? Not at this time. At this time, right? Yeah. Yes.
So you're saying that like the value of the stock in the future dividends plus the prior year's price. I mean, isn't there other factors that go into the stock price, not just the dividends alone?
Yeah, this is the price at the end of the first year. Piece of 1. Piece of 1 stands for the price at the end of the first year. Piece of 0 means stock price right now. So piece of 0 means right now.
So you're saying dividends expected plus the prior year, pretty much, right? Isn't there other things that go into consideration when valuing stock? It's not just the dividends.
Yeah, the value today is what? The present value of the cash flow you expect to receive. Yeah, what about piece of 2? Yeah, we can expand to third year too. What's the stock price at the end of the second year? We expect to receive what? Piece of 3. And then when we sell, the price is going to be piece of 3, right? So what's the stock price at the end of the second year? Same thing. What's the power? 1, right? But we are talking about actually second year model. I mean 2-year model, right? 2-year model. Oh, look at this. We need actually a little bit of algebra. I said. Yeah, piece of 1. When we calculate the stock price with 1 period model, what's the piece of 1? This is actually what? The dividends and the cash flows you expect to receive during the second year, right? So we can actually what? Plug in. Plug in and simplify. A little bit of algebra. Right? Yeah. Okay, we can actually plug in and simplify. This of 1 plus. Right?
Can't you just cancel out the $1?
No, not cancel, but yeah, rather than cancel, yeah, these are actually for the denominator, right? Yeah, how can we simplify this? These are 1 over 1 plus R, right? And plus this of 2 plus this of 2 over what? Square, right? So we can make one more step. Yeah, we can this of 1. How about that? Yeah. Because we're gonna actually what? Separate dividends and the price. That's all. Just like when you calculate bond calculation.
But if we use the first one, we have the same method.
Huh?
We can use.
Simplified.
Just simplify. So we are still in what? Two-period world. Two-period model, right? So same as before, how this is what the stock price today for two-period model. If you invest 2 years, if you purchase the stock and then hold 2 years and then sell at the end of the second year, the stock price is what this.
2 years in dividend.
You're gonna receive dividends 2 years, right? For 2 years. At the end of the first year or during the first year, and then at the end of the second year or during the second year, then you sell at this price or just present value. What about third year? 3-year model. Yeah, you hold 3 years. Then you need to what? Plug in again. Yeah, this and simplify. Then what you expect to?
Can you write it out?
Then we're gonna have what? This of 1 plus R plus. So we have actually pattern, right? Square D3, then this of 3 R cube, right? And then piece of 3 over third, right? So we continue this process, this kind of process. So let's expand to n years. Let's say this is a piece of n, right? And a piece of n. And the year before is 1 minus 1, n minus 1, and n minus 1, right? Look at this. What's the stock price today? It's same concept. Present value of another set of future dividends. So how many dividends do you expect to receive in this n period model? N times, right?
Yes.
N times. You're going to receive dividends n times. And even further, even more distant stock price. So this is what? This stock price is what? Let's say n is 50 years. This is the price after 50 years. Yeah, what's the present value of about $50, for example? Yeah, what's the present value of the stock price $50 after 50 years? If you calculate present value of that, that amount is going to be what? It's going to be minimal or the significant amount. If you calculate present value of $50 in 50 years, we can ignore that amount. Maybe $1 or whatever. So the stock price becomes what? Look at this. The stock price is nothing but present value of all the future tax, the future dividends you expect to receive. Actually paid to shareholders. At this time, we can ignore what? The stock price. 50 years or 100 years. So we talked about what? The corporation actually exists forever. 100 years or 200 years. The present value of stock price in the 50 years, the $100, 100 years or $200 is minimal. You can ignore. So the generalized model, generalized stock valuation model is like this. The stock price is what present value of all the dividends forever. So we can use this kind of notation, right? Perpetuity, perpetual existence. Or we just need to focus on the time pattern of dividends. That's all. Pattern of these dividends. This pattern could be what? Increasing. Yeah, it could be decreasing. I mean the constant, or decreasing, or fluctuating. Yeah, we can think of a couple of different pattern, time pattern in the future. So this is actually diagram, the graphical representation of those. Constant growth, dividend is growing. Dividend is growing constantly, and dividend could be what has no growth. Dividend could be what decreasing. Well, we don't want to think about that. And another case is what?
No, it's T equal.
Non-constant, opposing constant, non-constant, but dividends could have abnormal growing for first 3 years or 5 years, and then follow the normal growth rate. So this chapter actually focuses on these two. We're going to talk about this first, constant growth case. And then at the end of the chapter, we're going to talk about this kind of case, non-constant growth. Could be a little bit complicated. So you're going to have this calculation test. This one too. Why do we use it? So, first, if dividend is growing, if dividend is growing, what kind of cash flow we can think of from chapter 4? This kind of case. Dividend is growing.
Annuity.
Annuity? What's the annuity and the perpetuity? What's the difference? Annuity has what? Annuity has what? The end, right? Is defined period. But what's the concept of corporation? Perpetuity, forever. So we need actually perpetuity, right? But in this case, what? Dividend is growing, so growing perpetuity. Growing perpetuity. We need this kind of cash flow. But thanks to the mathematicians, they already developed a model, right? What's the model for growing perpetuity at the time? E over R minus 3. But in this case, our cash flow is what? Dividends, right? So just change to dividends. That's all. And that's the stock price. That's the stock price today. Oh, this is so-called a constant growth model, or normal growth model, or golden growth model. Yeah, 3 different names. Constant growth model, and normal growth model, and golden. The person who developed this model, golden growth model. Well, nowadays, I never seen this name of actually.
Right.
Normal growth model. And this kind of case, as we said, dividend growing what 20% or 30%, first 3 years or 5 years, and then follow normal growth. Let me just introduce the type of equation. This kind of model looks like this. Yeah, we're going to talk about this type of calculation later. Like this of 4, then I minus G. So first 3 years, dividend growing maybe 10% or 20%, and normal growth, 10% or 20%, 30%, and then follow normal growth. Yeah, let's talk about this case. Yeah, look at the example 7.2. Okay, before we talk about example 7.2, I'm gonna write a equation. Equation for constant growth model.
Like that leader. And it's when you stop like a year, stop growing. Like for example, you stop at 5 years, it's 25. It is 25 as well.
No, I don't know.
I don't even know what it does. At least we know about what
R stands for required rate of return. And we could say cost of equity capital, cost of capital, or opportunity cost of capital, but specifically equity capital. And that's the actually discount rate. We use that as a discount rate, the required rate of return. And the cost of equity capital. And G is growth rate. So let's say that G sub 0 is what? That's the dividend today. Or we could say any value known to us, G sub 0. Not expected value, but known value, not forecasted value. It could be dividend last year, or it could be dividend this year. So way known value. Let's say growth rate is 3%, for example. 3%, and the current dividend is 5 years. What's the this of 1? This of 1. What's the this of 1? This of 0 is $5, right? What about this of 1? The dividend 1 year from now. Yeah, what's the formula? Formula 1 plus G, right? Today's value is 5, and the growth rate is 3%, right? So what's the this of 1? This of 1. This of 1. $5 times 1.00, or $5.50. Is that correct?
Yeah.
Right, after 1 year.
3%?
$5.15. What about dividend 2? This is this of 1, right? This of 1. What about this of 2? This of 2 is this of 1 times 1.03, right? Is that correct? I spend actually more time. I'm going to spend more time on later chapters, right? I mean, chapter 7, chapter 8, 9, 10, because it's more complicated, important compared to the previous chapters. Okay, what's the this of 2? This of 2, this amount. 530. So how did you get that? 5.15 and 1.03, right? Is that correct? Is that what you calculate? Say it again, 530. Okay, that's the this of 2. Actually, you can calculate this way too. Like what? This of 0 times 1 plus G squared. How about that?
Yes.
Right? Okay, very good. 1.03 squared. You're gonna have the same number, right?
See.
Just a little bit of algebra, that's all. Yeah, so we can calculate actually what the successive the dividends in the future. This of 3, this of 4. So you need this kind of concept, the later calculation, so the later calculation, right? Okay, let's talk about this. And one thing for this, in order to this model, the constant growth model varies. Sorry. R should be what?
Constant.
Greater than 0. If G is greater than R, then what? Denominator becomes what? Negative, right? So this model becomes invalid. It doesn't work. So this is an assumption of this model. Okay, 7.2. Yeah, the information we have in this example is this.
Thank you.
Yeah, we need to calculate stock price today. Yeah. So any comments, any clue how to calculate piece of 0? What's the clue here in this information? Yeah, this question actually that information tells us the dividend, the cash flow looks like what? Is no growth or constant growth or any others? Constant growth, right? What information actually tells us this company actually pays constant growth.
G, D.
G, right? This information is the most important. This information tells us we need to use what? Constant growth model. Dividend is growing. This one tells us dividend is growing 2% every year. Right? So you need to be very careful when you read a question. If you have this information, then automatically actually we assume this company actually pays dividends. Dividend is growing. Yeah. By 2% every year. Okay?
Yes.
So even if you come to the class, if you don't listen, it's nothing, right?
Yes.
Why you come to the class? You don't listen to this. It's nothing. Wasting time. Wasting time. Yeah, what's the appropriate model then? Once you recognize.
230.
What's the model?
D.
D sub 1 over R minus G. Yeah, if the information of dividend is not D sub 1, you need to calculate D sub 1. Let's say if D sub 0 is given, then you need to calculate this. Just like this. We need this kind of calculation. If the information given is the dividends today or in the past, then you need to calculate what? The dividend you expect to receive next year. Otherwise, your calculation is wrong. So you're going to have actually partial point in the test. You know what I'm saying? So that's not accurate. But incorrect answer is incorrect. It's wrong actually. But only actually the teachers consider that kind of case. But in the world, nobody. Zero. If your answer is wrong.
If you're at D0, right, if you need to get to D1 first.
Okay, next one, 7.4.
D1
Yeah, more important, the information. What's the title of 7.4?
So D1 is right, this. D0 times this 1.0.
Okay, very important, very basic but fundamental issue, very important issue. Dividends versus investment and growth. Very important issue. Trade-offs. What trade-off we are talking about? Number one, pay all dividends out to shareholders. The second case, retain earnings, profits, and reinvest. Very basic but fundamental issues. Very important. And what information we need to look at to talk about this? The income statement or the balance sheet? To get this information. Income statement or balance sheet? Income statement, right? Well, what portion of income statement? Upstate or downtown? Uptown or downtown? Downtown. So we need to look at actually bottom of the income statement. Net income. Let's say your company issue only common stock, not the preferred stock. Then net income is same as earnings available to common stockholders, right? The net income equals to earnings available to common stockholders. So if your company issue preferred stock, then what? Net income minus dividends to preferred stockholders And then earnings available to the common stockholders, right? Let's ignore that case. So what's next? Dividends, right? Dividends to common stockholders. So what's next? Increase in retained earnings, right? Increase in retained earnings. Yeah, change in retained earnings. Change in retained earnings, or increase in retained earnings, hopefully. And you close, and then transfer to what permanent the account, retained earning account, right? Erase this. Yeah, what's the EPS? EPS is earnings available to common stockholders divided by
Shares.
shares, right? Number of shares, right? Yeah. Since we assume net income is same as this, net income divided by number of the shareholders outstanding equals what? EPS, right? So net income divided by number of shares outstanding. That's EPS. Let's say EPS is $5. And the company pays dividend, then retain. Retained earning is, let's say, $2, and the dividend is $3. And we can calculate dividend ratio, dividend payout ratio. What's the dividend payout ratio? How to calculate that? And then the second is retention rate. And my previous textbook used plowback ratio. Same thing. 3 years ago, one student pronounced like it's plowback. I say plowback. Which one is correct? I don't know. Plowback. Maybe that student came from Texas. Actually, I came from Texas. Plowback ratio, or this textbook uses this term, retention rate. Plowback ratio. So how to calculate dividend ratio? This is the let's say dividend equals, dividend ratio equals earnings. No. Dividend divided by EPS. That's the dividend payout ratio, right? Small d means payout ratio. So in this case, $3 divided by $5. So what's the dividend payout ratio?
3 out of
60%. Ratio is percent, 60%. What about retention rate? In this case, we don't have specific notation like this. So retained earnings divided by EPS.
That's fine. 40%.
40%. 40% retention rate. There are two traditional classification of stock. So nowadays, so many different classifications, but traditionally income stock and growth stock. And they pay out. Dividend yield is very high. Then ratio, dividend payout ratio is very high. Dividend payout ratio. So dividend yield is high. Dividend yield. What's dividend yield? Like the current yield in bond calculation. Dividend yield. How to calculate dividend yield? How did you calculate current yield in bond calculation? Coupon divided by
1+.
coupon amount divided by what? We forgot after the test, right? Current yield. The bond calculation. How did you calculate current yield? Coupon payments divided by
1 plus.
coupon payment. Is it 1 plus I? 1 plus I? Why?
You got it, you got it.
Yield to maturity.
What's the
1 plus the yield.
no,
No numbers given.
Nobody remember? Current yield. Yeah, we talked about 3 different types of return.
Current price.
One is current yield. What's the another? 1, 2, 3.
Price.
No.
Yield to maturity.
Return. Yield to maturity. Very good. Yield to maturity. And third.
Coupon.
3 different types of return.
Turn on equity.
Holding period return. Holding period return. Let's say you purchase bond and hold 1 year or 2 years or 3 years and sell. You can calculate actual rate of return. This one is what? This is the return. If you hold that bond until the maturity, right? You expect to receive many dividends and how did you calculate? Again, P. Price. Your initial investment. Yeah, price. Your investment. Yeah, your investment. Yeah, what's the current yield this year? Current year. Current year. So you invest. Yeah, $900 could be $900 or it could be 1,010, 1,100, and then you receive coupon this year. That's the current yield. What about dividend yield?
Price?
Price. That's dividend yield. Your investment, you purchase at a specific amount, in stock investment, and then you receive dividends. Dividends this year. Current dividend yield this year. So income stock dividend yield is high, right? Dividend yield is high, and dividend payout ratio of course high. High. What's the growth rate?
Change in stock price.
No dividend or relatively small dividends.
Or change in stock.
No dividend or small dividends. So low dividend yield. Low payout ratio. Low dividend payout ratio. Then what? High
Stock value.
callback ratio, like retention rate. So opposing concept, right? And the future growth earnings high. Capital gain is high. So what kind of stock is example of this? Income stock or growth stock? What kind of stock? Example. Is AT&T established and especially utility,
8% dividend.
utility company, industry. And what about this? Example,
Apple.
Apple, technology. Technology stocks. Like Yahoo, a lot of technology stocks. Belongs to this category. Those, their dividend payout ratio is very low. So rather than paying out earnings, they retain. Why they retain rather than paying out dividends? If they have what investment opportunities in the future, right? What is the best source of financing? What's the best source of financing from stock, bond? And retained earnings. What is the best source of financing?
Bond.
Stock, bond, retained earnings.
Bond. Three. They're all there. It's like bond.
The answer is bond, sir.
Bond.
These two are so-called what? External financing. External source. Financing from others, investors. Retained earning is what?
Internal.
Internal financing. Internal source.
There's advantages and disadvantages for all three of them. You can't say what the best one is. All right, you say what it is, and then I'll bring up the point.
Not really. Not really.
All right.
That's actually you can talk between these two that way. But in
The answer
general,
bonds?
which one is the best?
Bonds.
Bonds, sir.
No, it's
Let me ask you this way: external financing is better or internal financing is better?
You have more opportunities to raise.
Yeah, let's talk about this. Yeah, think of principal accounting 2 maybe. Shareholders equity. Yeah, 2 shareholders equity. Yeah, so read the shareholders equity section of your balance sheet. Right? One is how you write in the your balance sheet.
What do you mean?
Paid in capital, right? Paid in capital.
Paid in excess of the bar.
Yeah, paid in capital. One of the word contributed capital, right? Contributing capital. The investors contributing. Owners contributing capital. What's the other kind?
Additional.
Paid in capital.
Additional.
What's
No,
the
paid in
other?
excess of par. Additional paid in capital.
One is what? Paid in capital. The other one is what? Owned capital. What's another name of owned capital? Another name of retained earnings. Retained earnings. Same thing. What kind of paid in capital
Additional paid.
do we have?
That's stock and bond.
Stock and bonds, right? Stock and bonds. Equity, bond, the debt and equity, right? Stock and bonds. But we are talking about actually what? Not bond, right? We are talking about shareholders' equity. So, what kind of stock? Common stock and preferred stock. Right?
Stock and bond.
What's the source of retained earnings? What's the source of retained earnings?
Dividend. Net income.
Net income, right? Profit. Net income. So source of retained earnings is what? Net income, profits. At the end of each year, you close, right? The temporary accounts, and then what? To move to transfer to what? The permanent account, right?
Professor, what's the answer?
So I thought you already recognized the answer, but still Internal source is better. Internal source is better. So you make profit Yeah, you make profits, right? Out of your operation of your business, and then you retain.
Yeah, but if you don't
Okay,
have.
that's the best source, and the cost of capital is lowest. It's all cost of capital. So if you issue stock or bond, the cost of capital is much higher than
But if your
your money.
company is not doing it, you
Yeah.
better
So as we said, what's the concept of debt and equity? Balance sheet. Look at the balance sheet. The asset, liabilities, and the equity. The liability is what the creditors claim and the owners claim, but from the standpoint the standpoint of corporation, all of these are liabilities. Liabilities. So what's the next? Bonds. Bonds. And the stock. Because information cost is a lot. So I think it's time to go. So next time we're gonna continue this.